Welcome to Financial Plan and Explain. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm proud to have with me today Brad Sorensen, who's a chartered financial analyst, a CFA, the investment guru, guys, and he's with Cornerstone Portfolio Research, which is a consulting firm that we use. Brad, we speak with Brad every week, and we have longer meetings every month. So, Brad, thank you again for joining.
Thanks for having me. Glad to be here.
So normally every quarter we have 2 or 3 episodes where we talk about what's going on in the prior quarter, what's going on today, and then on a move forward basis. However, breaking news, every single day, every single hour, every single minute is glued to the headlines with the president and Iran and the Middle East and the Straits of Hormuz. And it's just it's masking. As I write in my weekly recap, I keep saying that the economic data is being masked by the headlines of what's going on in the Middle East. So what we're going to do is we're going to uncover a little bit what is going on truly in the U.S. economy after we, peel away the masking of it. So I guess, Brad, you wanted to talk about the job market. Clearly, I mean, this comes around to the Fed, I suppose. The Fed, we always talk about the Fed has 2 mandates, the job market and price stability, which is inflation. Well, that's been thrown out the window with the Straits of Hormuz and the war with Iran. So let's throw all that crap out. Let's talk about what's going on, Brett.
Yeah, well, there is a lot of going on, and that's, the market is now kind of turning its attention with one eye on the Iranian situation and one eye on the rest of the economy. And just quickly, and we're going to talk about earnings later, but this is why we pay attention to employment and inflation because they impact earnings. So where's employment? Well, that's a mixed picture. And there's people out there complaining that we're not seeing a lot of job gains, but they don't point out we're also not seeing a lot of job losses. That's a situation that's unique this time around. Usually, when you see these employment markets start to soften, which we've seen it soften from a very strong base, you start to see more layoffs because people get nervous that their businesses are going to weaken, that consumers aren't going to have as much money because they won't have as many jobs, they won't be making as much. So they trim payrolls in advance of that. That's considered the leading indicator is job layoffs or jobless claims, which we get weekly on Thursdays. But we see that's still at historic lows. So companies aren't laying off people. They're still confident enough in the economy. They're seeing enough in demand. So what's going on? Well, that's speculation. There's several reasons why people aren't adding jobs like they were a couple years ago. One, we overhired coming out of the pandemic. A lot of tech companies overhired so they can still absorb some of those workers into their workforce now. Two, there is some concern still with the Iranian situation and the tariff situation. That's still not settled. Even the Supreme Court ruled that those tariffs were illegal, but President Trump has said he's going to implement new tariffs under a different code. That gets a little complicated, but they're uncertain about that. So that uncertainty makes them a little hesitant to invest in a lot more employees. And then there's the big elephant in the room, AI. And how much is that impacting employment? And that's where we don't know exactly, but we are hearing from the companies that they're not necessarily laying off people because AI can do the jobs. That's what we're seeing. They're not really doing that because we don't see layoffs. But it does seem there is an increase that they expect AI to be able to do more, and they're hesitant to hire people because they think AI functions will be able to replace some of those people they wouldn't needed to hire and make their current employees more efficient. So they won't need to hire more people, even though their business is getting better. So that's kind of the combination. So the Fed is trying to deal with that and really get a handle on, is the employment market getting weaker? And right now, it really doesn't look like it is. The unemployment rate still remains very low at about 4.4%. That by most economists' estimate, is about as low as you can go for a non-inflationary employment environment. You're always going to have some friction in there, so you're going to have between 4.2 and 4.5% is kind of the estimate. So we're right in there. So I don't think the Fed feels like they need to be too aggressive at this point to address what's been a slowdown in job gains, but we haven't seen the job losses. So that's a long-winded answer to the labor scenario right now.
Well, it's interesting that, you talked about a lot of the domino effect of the labor market. The labor market also has an impact on people's psyche in that if I'm fearing that I might lose my job, I'm less apt to be making big purchases. I'm less apt to buy a house, less apt to buy a car, maybe less apt to do vacations, et cetera, et cetera. But then if there's confidence that my job's going to be there and my company's not going to be doing layoffs, well, then I'm more apt to spend. And so you could see how that's happening. And the chart that you showed really is a very nice chart. And until I saw that chart, I didn't realize how robust, if that's the right word, sort of in a negative way, when you look at job claims, that's people being laid off, they go on claim. We're at a low here right now, at a very low.
Yeah, and that does give yeah, you make a great point. If you're in a company, even if you don't get laid off, if you see a round of layoffs, if you see, your next door neighbor get laid off, you start to get nervous. You may, yeah, curtail spending plans. So that does have the psychological impact. Same way with inflation, we talk about that. Chairman Powell talks about the inflation expectations are really important and employment expectations are the same. We look at quit ratios, for example. People more confident in the employment market, they'll quit because they're confident in their ability to get another job. And we've seen the quit ratio come down a little bit, but not too much. It's back more to normal levels. It got very high because there was a while there, and that's the other thing. We're coming off of a period where employees really had the upper hand because employers were desperate to get workers. And if you looked around, if you remember a year and a half ago, almost every store you went into in a lot of cities had help wanted signs on it. And now we've started to see that moderate, and now we're in a more even where labor providers and labor acquirers are about even, and that's a more healthy environment. We don't want workers that feel like they can quit at the drop of a hat. We want them kind of tied to these companies in some ways so they can get the skills they need. And that's what we're starting to see. But there's still, like I said, employment hasn't risen and there's still jobs out there to be had.
Well, that's good. I mean, so it sounds like the labor market is a lot more stable, or maybe to your point, is less concerning than people originally were worried about.
Right.
So that's the one hand that goes into the Fed's job. And we'll talk also about the fact that the Fed chair is about to change in the very near term. In fact, the new one that's being proposed is actually testifying in Congress today. But be that as it may, there's the other hand that goes into what the Fed will do. We've been talking for over a year that the Fed was looking at lowering rates up to 3 times or more. And now, since the job market is stable, the other hand is inflation, which had been going down, but thanks in great part to our lovely thing that's going on in the Middle East, there's a concern about inflation associated with energy prices.
Yeah, this gets again. This is why this time in history is very interesting. It gets a little complicated when you hear, the chairman of the Fed say uncertainty, 10 times in his press conference. That's kind of where we are. That the chairman of the central bank is uncertain. That what are we supposed to know sometimes? But you know, moving from labor to inflation, labor impacts inflation as well, and that's where the Fed feels better because everybody wants people to have jobs, but then they don't want inflation to go up. Well, when the labor market's too tight, you have to pay workers more to get those jobs. and get those employees that you need. And we're starting to see that reduce. So that should help inflation. But we have the Iranian situation. Now, Chairman Powell has said he believes that's a temporary issue. So it's really not going to affect the Fed's decision making too much. And there is the idea that, do higher oil prices impact inflation more, or do they impact the economy more? So is the risk to the, and this is what they're grappling with, does it make the economy slow down because you have to pay more for necessities like gas and heat and all energy related items? Or does it increase inflation because not only energy goes up, but there's inputs to a lot of products, those input costs go up. And that's where, if we only, like it, we're on the, it seems like we're on the verge of some deal potentially. And then it's really not that big of a deal. Inflation will go down. This will be a temporary thing. The Fed won't take it into account too much. But if we get a elongated period of higher oil prices, they're going to have to deal with that. And it will certainly impact their actions going forward. They're just not sure how yet, because they'll have to watch whether it affects inflation more, which we know it will, or will impact employment. Now, the last thing I want to say about this is that the Fed, you're right, they have a dual mandate, but Powell has consistently, and the Fed, as it's constituted now, has appeared to most investors to be more concerned about making sure the economy keeps going and employment stays robust rather than inflation running a little hot.
Well, so it's interesting that what you said, and made me think about it, is inflation's running hot. The immediate knee-jerk reaction is, oh my goodness, this is going to be a big inflationary problem with oil prices going up. However, if I have a finite amount of money that I can spend every month, and now the cost of oil and the cost of goods goes up, I'm going to be forced to reduce my spending on other things, which could be actually recessionary.
Yep. Yeah, that's what makes this a difficult time, is that they probably don't want to cut rates if prices are going up, but if the economy is declining and consumer spending is going down, this is one case where cuts might help, because then they could, their borrowing costs would be less, companies' borrowing costs would be less, so to help offset those rise in oil prices. So that's the conundrum that they'll find themselves in, that likely will be passed off to the new chairman in the end of May.
Yeah, welcome.
Welcome to your new job. You have this to deal with.
Well, on that note, you were also saying that from an economic perspective, the inflation is rather bifurcated, meaning that the wealthier are basically not impacted, but it's the lower income that are impacted more. Do you want to share more about that and its impacts?
Well, yeah, that's what, especially on the energy related, that unfortunately that impacts obviously the people with lower incomes, because that makes up a bigger percentage of their expenditures. So, and they're more sensitive to those changes. Another, $20 in gas a week, that makes a big difference to a lot of people in the lower and lower middle income people. So the Fed is sensitive to that and they watch that, but overall, that doesn't really matter to the economy that much, because those people don't have the spending power to drive the economy. So that's where we go. Richer people, upper middle class and rich, they really aren't impacted by, $20 more in gas, or a $50 more electric bill. That doesn't impact them. They won't even notice that. So their spending patterns probably wouldn't change. And that bodes well for the US economy overall, because that's where the bulk of consumer spending comes from, is from those groups.
Hmm. Interesting. So here's a good opportunity to take a break. And what we'll do is we'll pick up on the second segment and we'll talk about kind of like where the markets are right now, but understanding too that the markets are driven by the actual stocks, because that's all the markets are, is a collection of the stocks. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. Still here with Brad Sorensen. Thank you again, Brad. So in the first session, we were talking about pretty much, the labor market and inflation. And, what we're trying to do is look behind the curtain, which the curtain is a thick curtain going on right now with the conflict going on in Iran and the closure or the opening and then the reclosure and then the reopening and the closure of the Straits of Hormuz, which are causing the markets to fluctuate dramatically. But on that note, the markets, and there's a figure here that shows it. So the markets have actually reached, two of the three indices, being the S&P and the NASDAQ, have reached all-time highs. And in fact, what happened is the attack on Iran by Israel and then subsequently the United States occurred on February 28th when the markets were at their all-time highs. Then all of a sudden they had roughly a 10% correction during the month of March. A correction is considered anything 10% or more, and I believe two of the three indices had breached it. But then in the last 2 weeks, we've recovered that 10% and then some. We're back to all-time highs on two of the three indices. And Brad, I think you even said it in our meeting this morning. This was the fastest recovery ever by the markets from a correction.
Yeah, it was remarkable. I think it was 11 days that we went from the correction lows, which was right at 10%, just touched it, to now recover all of those losses. That was the quickest turnaround that we've ever had. And that shows the trying to time these markets is a virtual impossibility because of the changing nature of them, and that they seem to move on a social media post from certain areas of the country. But yeah, if you blinked, you miss the correction. And that just shows why, diversification and not trying to time these things is important. But it also shows that investors really were never worried about Iran. They got a little nervous about it, but they always were looking for opportunities to get back in. And that continues to my belief, and I think our belief, that the bull market is still intact, even though we have that correction, and that investors they're scared of missing out on the upside. So the bull market's intact. There's a bullish mentality. They're not looking to sell on any bad news. They're looking to buy on any good news.
Well, so interestingly, if I take where I am today to where I was in the middle of February, I felt really good on a move forward basis about the economic outlook, because the things that we were talking about before this whole Iran thing was the concept that we're going to have the biggest tax returns, refunds, and it's going to spur the economy, and inflation's going down, and these are all the different things that we're talking about just 2 months ago. Yet today, the markets are at a point that are even higher than that, with all of the risk in the markets right now. And I think you even elaborated earlier today that you were a little concerned that the markets are a tad frothy right now.
Yeah, in the near term, whenever you just see an 11-day 10% correction erasure and about 13% gain in less than 2 weeks, that is the very definition of overbought. And that there are still risks out there, like the Iran situation isn't done. There's the Fed situation that we don't know what's going to happen necessarily, if that's going to get bumpy. There's new tariffs that might come online, and that could cause some issues. Now, none of these things are catastrophic. They're not going to cause problems, but they could cause ripples in the market. And just there's the old sentiment indicators, and it's very optimistic. And we don't, if you're a trader, this, that the retail investor is the worst. They're a contrary indicator. When they're very optimistic, the market's going to go down. And we probably will see a bit of selling in the near term as people look to take some of the profits from the massive rebound that we've had. And there are still some risks that could result in some air pockets, but there's not a serious, like, the economy looks strong, earnings look really good. So at this point, it's more likely that there's small short-term declines, even like we saw. That was an extreme one, but with the Iranian situation, that recovered pretty quickly because the underlying fundamentals of the economy and earnings still look good.
Well, it reminds me of the boy who cried wolf. It seems as though every quarter, really beginning with the tariffs, and by the way, this is every quarter, but I'm only going to take it within the last year. So the tariffs, this reminds me a little bit what happened last year. We had a major correction. I say major. We had a correction in 1 month. We had a correction last year in 1 month because of the tariffs, this month because of Iran. And every quarter after that, we're saying, well, let's see the impact on earnings. Let's see, it's not going to happen this quarter, but each of the CEOs are going to get up there and talk about, well, while we had a good quarter last quarter, all these tariffs are going to kill us. And then next thing you know, the next quarter they come in, well, the tariffs didn't really hurt us and we're still robust. And we keep hearing all of these, the boy who cried wolf, as to why this quarterly earnings isn't going to be as good and the outlook isn't going to be that good. And we're really, really early into the earnings season. And aren't we kicking butt right now?
Yeah, the start to earnings season, like the expectations coming into earnings season were high, about somewhere around 13% year over year earnings growth, which is very good. And so far, it's pretty early in the earnings season, but we've heard from the financials. They're reporting good earnings releases. We heard from some healthcare companies. So far, they've been pretty good. There's been a couple of misses, but that's always going to happen. But overall, the earnings season to this point has been good. And that just goes to, like you said, this is, I don't want to get too far down this road, but I have a US flag flying outside my house, but there is something about the United States companies, a company in the United States that, like we saw with the tariffs, everybody thought that was going to crush them. Those companies found a way around them to deal with them, to still make money on them, like you said, and we rebounded, and the earnings were still pretty good in light of all those tariffs. Earnings 13% year over year this year. And that's where it is tough to bet against American companies being able to overcome these near-term hurdles that they have, like the higher energy costs. They'll be able to deal with those. Now, if we get higher oil prices in the 120 to 150 range for 6 months to a year, that would start to cause some problems. They can't work forever around that. But these near-term blips, they can work around really well. And that's what we're looking for in earnings season. Now, how much forward guidance we'll see, we seem to be getting less and less as the quarters go on. And probably for good reason. They have good excuses that if the Fed chair is uncertain, well, they're probably uncertain about what the business environment will be. But so far, we haven't seen a lot of warnings. The financial companies, for example, said that consumers look healthy. There's not an increase in debt defaults. That's kind of the first thing we usually see. So that's all positive. Now, going forward, we'll be looking for forward guidance from some of the tech big shots. We haven't heard from a lot of them yet. And how much capital spending they're going to do, if they're pulling back on that any. How much AI adoption we're seeing. We're looking for all those things, but right now it still looks like things are in a good shape and earnings are in positive territory by quite a bit.
Well, that's good because fundamentally, the stock market is nothing more than a collection of individual stocks. And the value of an individual stock is based upon its earnings growth, its dividend and dividend growth. At the end of the day, if a company's making money, its stock price should do well.
Yeah, that's that's a great thing to remind investors. We talk about all these other things. We only talk about these things because they flow through to earnings. That's what, over time, earnings are what drive the stock market. There's going to be sentiment things that make it gyrate, but it went down in April in March because of the Iranian situation, because they were scared that earnings would be hit because of the higher oil prices or the lack of shipping. So it's always relates back to earnings. We're worried about the employment market because if consumers don't spend, earnings will be hit. So yeah, it's always important to pay attention to earnings at the end of the day and what they're forward looking. We don't want to look too much in the rearview mirror, but we want to look at, are their spending plans good? Are they seeing consumer demand? Are we seeing their expansion plans intact? All those things, and so far so good.
So one thing that I'd like to ask you for the viewers, we had during the period of the Straits of Hormuz, everything got smoked except one thing: energy. Energy, take for instance, not promoting, but ExxonMobil, Chevron, all of the energy companies. I just think about it, and please correct me if I'm wrong from a very simplistic understanding, but they weren't really impacted because they're generating their own oil, but instead of them generating and distributing oil that they're used to doing at $70 a barrel, they're able to distribute it at $100 a barrel. So their costs remain the same, but their revenue just increased by 50%. Is it that simple as to why the energy companies did so well over the last month or so?
It's basically that simple. There's not a lot of analysis that goes in. Like a lot of the analysts didn't raise earnings estimates all that much for these energy companies, because we don't know how long it's going to be. Their costs still go up some because they use energy and it's a global market. And if you go forward, there's a reason why OPEC and Saudi, they don't want, you'd think they would want oil prices. They would love oil prices at 150 because they could sell their oil. They've learned that they really don't want them above 80, because once it gets above that, they start to see demand destruction. And once it gets above 100, they really start to see that over time. So they want to keep demand robust. So that's where the demand supply curve stays there, and it's really between that 60 and 80 number. But there are two things: that a short-term earnings bump combined with just sentiment is just kind of investing 101. Trouble in the Middle East, buy energy. Trouble in the Middle East, buy energy. That's what you always see. And that was just kind of part of this. And when you're selling other things because you're worried about their earnings, you have to put money somewhere. And energy kind of makes the most sense because they'll at least get an earnings boost, at least short term, from the higher oil prices.
What about nuclear power? I mean, nuclear power actually took a little bit of a dip during all this. Was that related? I was just thinking about it again from a practical perspective. If oil's $100 a barrel and there's a high demand for oil because of all the AI and everything else like that, which has been discussed, there's a greater need for energy. Well, nuclear power is an alternative to energy or alternative to oil. One would think that when they see oil prices going up, everybody would say, hey, look, now's the time to invest into nuke. But nukes didn't really go up. They went down with everything else.
Yeah, that was a lot of just kind of the general risk off sort of mentality, because the nuclear stocks had run quite a bit over the past 6 months to a year on that speculation. And the other thing is that nuclear is more of a longer play. Like, you can't bring a lot of nuclear online in the next 2 to 3 months. So they're not going to benefit from this. And investors think that this will be a short term scenario. And there could be a back of the mind that maybe some of the investment will go into, like in Europe, maybe they'll invest actually a little more in their own oil supply chain rather than nuclear. I don't think that will happen, but some of that speculation could go because they could realize how much risk they have from trouble in the Middle East and the Straits. So I think all those things, but it was mainly just a risk off thing, a reason to take profits, especially those stocks that run quite a bit over the past couple of years. And I think that's still a good investment, still loving the nuclear space, because I think that is the long term answer. And we're seeing more and more AI companies look to the nuclear area, especially the mobile nuclear mini plants that they have they're much safer, they create much less waste, and they're much quicker to bring online. Those are becoming more and more popular as well. So I think the public is getting more comfortable with nuclear. There's more, there's safer and cheaper nuclear solutions out there, and the government's starting to get on board with that as well, both here and overseas.
Last question, going back to oil again, because we're out of time now. Um, a lot of countries, because of the loss or the restrictions at the Strait of Hormuz, a lot of countries were apparently now buying oil from the United States. Did that actually provide a favorable economic impact to the United States because of we're now selling oil? And I just think from a very simplistic business thing, if the United States is running at a deficit where we're spending more than we're bringing in, I would think that this helps the United States by selling our oil and bringing money in and improving our imports. Am I missing something? Or is that just
No, I think all our favorite phrase, all else equal, that is true. We are going to get a revenue bump from the oil we sell overseas, just like coming the energy companies will, no doubt about that. But we are also spending money on the military actions in Iran. So I'm not sure that most people would look at that as probably a wash on the revenue front. So it will probably help a little bit, but not enough to make a huge difference, and certainly not enough to not to bring up another topic that we could talk about for hours and hours, but the federal deficit.
yeah, oh, good. It's been lurking out there, and it seems as though anytime there's something, it hides all the fundamentals or what's going on, and that's the thing that I dislike about these types of things. So, what I'm gathering from your sentiment is that it looks like this oil thing is probably short-lived, and that the economy is actually on good footing, and that once we can bury this, that we're moving forward in a very favorable manner. Would you agree with that?
Yeah, I think that's right. I think that we will still see some. I don't think the volatility is over. I think we'll still see some, temporary pullbacks in the market. But overall, the underlying fundamentals are good. The earnings are good. So just kind of ride those little air pockets out, and we look towards the other end of this, and things look good. Now things can always change, and we'll address that, but right now that's the situation. Good fundamentals, good earnings, and short-term oil that won't have a huge impact.
Anything else you want to add?
No, I don't think so. Just there are things that could cause some speed bumps, like the Fed chairman nomination process that could get a little bumpy, and that could cause some consternation in the market. But if you look forward 6 months, we're going to have the Iran situation will be over, and the oil prices will be lower, and there will be a new chairman. It'll all work out. So, and companies continue to hire, and we have the AI productivity boom that we haven't even talked about. So things are looking pretty good for the United States and their companies right now.
In other words, don't get lost in the headlines. That's what Brad just said. Brad, again, thank you very much. To the viewers, thank you for joining us. And I will have Brad back in the near term once things settle down so we could talk a little bit more on the forward looking, which we kind of talked about now, but let's get this thing in the Middle East settled out so we could focus on the economy again and not be clouded by the headlines. So again, thank you, Brad. I appreciate you coming on board again. And thank you to the viewers. I hope you had a great time today, and see you next week on Financial Planning Explained.